The dream of homeownership didn't just get more expensive in Canada, it became a mathematical impossibility for millions, not because of the houses themselves, but because of a silent, invisible algorithm known as the stress test. This is the story of how a single policy shift, designed to protect the economy from collapse, inadvertently forced Canada's largest bank, RBC, to rewrite its entire playbook for growth. We are witnessing a moment where the safety net has become the cage, and the largest financial institution in the country is now looking for a way out. This isn't just about interest rates, it's about a fundamental restructuring of how wealth is generated in the North. For decades, the Canadian banking model was a predictable engine: issue mortgages, collect interest, and grow alongside the housing market. But when the Office of the Superintendent of Financial Institutions introduced the B-20 guidelines, the game changed overnight. Suddenly, it wasn't enough to afford your mortgage at today's rates. You had to prove you could survive a rate hike of 2 full percentage points higher than your contract. This policy was the ultimate psychological shock to the system. It was a declaration that the era of easy leverage was dead. As the gates slammed shut on thousands of prospective buyers, the ripple effect hit the balance sheets of the big five banks, with RBC standing right in the center of the storm. The world is watching Canada right now because it represents a laboratory for controlled cooling. While other nations let their housing bubbles pop with catastrophic force, Canada chose a path of managed stagnation. But in doing so, they created a secondary crisis, a growth vacuum. If the average citizen can no longer qualify for the debt that drives bank profits, where does a trillion-dollar institution go to find its next billion? This shift represents a pivot from a consumer-led debt economy to an institutional-led asset hunt. The reaction from global markets has been one of cautious observation. Investors are asking if RBC can maintain its status as a global powerhouse when its primary domestic engine is being throttled by its own regulators. This event represents the end of the unlimited mortgage era and the beginning of a much more aggressive, much more complex era of corporate maneuvering. The stress test was designed to keep the banks safe from the people, but it has now forced the banks to look far beyond the people for their survival. And as the data begins to pour in, we are seeing the first signs that RBC's response is far more radical than a simple change in lending criteria. Because while the public was busy recalculating their down payments, RBC was quietly preparing a move that would change the map of North American finance forever. Behind the mahogany doors of Bay Street, the mechanics of the stress test triggered a psychological shift in institutional behavior. When a regulator tells a bank they can no longer lend to a specific segment of the population, they aren't just reducing risk. They are effectively devaluing the domestic market in the eyes of the bank's strategy team. This is the risk-weighting trap. To maintain their Tier 1 capital ratios, RBC had to find cleaner ways to deploy capital. They realized that the traditional Canadian mortgage, once the safest bet in the world, had become a regulatory burden. This led to a cold, calculated pivot toward high-net-worth wealth management and international expansion. The psychology here is fascinating. It's the Peltzman effect applied to banking. When you make a system safer, the participants often take more risks elsewhere to compensate for the lost utility. For RBC, that elsewhere became the United States and the acquisition of commercial portfolios that don't fall under the same restrictive Canadian stress tests. By tightening the screws on the average Canadian family, the government inadvertently incentivized the nation's largest bank to export its capital. The stakes are no longer just about whether a family in Toronto can afford a condo. The stakes are whether the capital generated by Canadian savers stays in Canada at all. This policy created a two-tier financial reality. On one side, you have the stress-tested class, the workers whose mobility is frozen by the inability to move or upgrade. On the other, you have the institutional class, where RBC is leveraging its massive balance sheet to acquire entities like HSBC Canada, a move designed to capture international trade flows rather than domestic consumer debt. This isn't just a business acquisition, it's a hedge against their own home market. The bank is essentially shorting the growth potential of the Canadian consumer in favor of the global elite. But here is the part nobody expected. The stress test didn't just slow down lending, it accelerated the concentration of power. Because smaller lenders couldn't handle the regulatory overhead and the increased capital requirements, the Big Five actually became more dominant. The policy meant to protect the system has made the system's too big to fail problem even more acute. RBC didn't just survive the stress test, they used it as a filter to eliminate competition. However, this consolidation has a dark side that is only now beginning to surface in the credit markets. The mechanisms are working exactly as intended, but the byproduct is a financial landscape that looks nothing like it did 5 years ago. And the deeper you look into the historical parallels, the more concerning the trajectory becomes. If we look back at the history of financial regulation, we see a recurring pattern. When a domestic market becomes hyper-regulated, capital behaves like water. It finds the path of least resistance. In the 1990s, Japanese banks faced similar domestic constraints and responded by flooding global markets with cheap credit, a move that reshaped global trade but hollowed out their domestic innovation. RBC is currently following a sophisticated version of this export model. While the Canadian government focuses on domestic stability, RBC is positioning itself as a North American bank that just happens to be headquartered in Toronto. This is a behavioral shift seen in power structures throughout history. When the center becomes too rigid, the edges begin to expand. Other global markets, particularly the US and the UK, are watching this with intense interest. They see the Canadian stress test as a double-edged sword. On one hand, it has prevented the Lehman-style collapse that many predicted. On the other, it has created a productivity trap. When a bank like RBC pivots its growth playbook toward wealth management and international commercial lending, it stops fueling the small businesses and the middle-class housing that drive a healthy domestic economy. Behavioral economics tells us that people respond to incentives, and right now, the incentives for RBC are to treat the Canadian consumer as a maintenance project rather than a growth project. The historical parallel to the post-2008 era in Europe is striking. Strict capital requirements there led to a lost decade of lending. RBC, sensing this potential stagnation, has proactively shifted its playbook to focus on fee-based income. This means they want your investment fees, your insurance premiums, and your transaction costs, rather than just your mortgage interest. They are moving from being a lender to being a platform. This is a fundamental shift in the power structure of the economy. The bank is no longer a partner in your debt. They are a landlord of your financial life. This gets deeper when you consider the geopolitical implications. A bank with the scale of RBC is a tool of soft power. By expanding its growth playbook into the US and Europe, it carries Canadian regulatory DNA into foreign markets. But it also makes the Canadian economy more vulnerable to global shocks. By forcing the bank to diversify away from the stressed Canadian consumer, the regulators have tied Canada's largest financial engine even more closely to the volatility of global markets. The strategy is brilliant, cold, and entirely necessary for their survival. But as the bank evolves into a global entity, the gap between its success and the success of the average Canadian citizen is widening into a canyon. It gets deeper as we realize that the very security we voted for is the same force pushing our national wealth into foreign assets. For the average family, the real-world impact of RBC's altered playbook is subtle but profound. It manifests as a credit desert for the unconventional worker, the freelancer, the entrepreneur, and the newcomer. As RBC's growth playbook shifts toward low-risk, high-fee models, the bridge to the middle class is being pulled up. The media focuses on interest rates, but the real story is credit rationing. The stress test has become a permanent filter that sorts the population into those who are economically viable and those who are statistically invisible. This is the part of the story the media isn't discussing. We are creating a permanent class of renters who are locked out not by price, but by a rigid policy that does not account for the modern economy. The stability of the Canadian market is undeniable, but it is a brittle stability. By forcing RBC to look elsewhere for growth, the domestic market is left with a bank that is physically present but strategically distant. When your country's largest financial institution views your mortgage as a regulatory hurdle rather than an opportunity, the very nature of the social contract changes. We are seeing a move toward financial feudalism, where the banks own the infrastructure of exchange, but the people can no longer own the assets. This is the pattern interrupt. We have been told that the stress test is there to protect us from a housing crash, and it might, but the cost of that protection is the fundamental restructuring of our economic DNA. RBC's growth is now decoupled from the prosperity of the average Canadian. They are winning by playing a global game, while the Canadian consumer is playing a game with a ceiling that gets lower every year. The growth playbook has been optimized for a world where the middle class is a service to be managed rather than a market to be built. The real shift isn't just in how banks lend, it's in how we define safety. We have traded the risk of a crash for the certainty of stagnation. As RBC continues to record multi-billion-dollar profits by looking beyond Canada's borders, we have to ask ourselves, who was the stress test really designed to protect? The systemic shift is already complete. The guardrails are in place, the playbook has been rewritten, and the engine of wealth has moved on. We are witnessing the birth of a corporate entity that is larger than the nation that birthed it, operating under rules that prioritize the survival of the institution over the mobility of the individual. Because while the world is focused on this, the real transformation is already unfolding, quietly, and in a place no one expects, as the next evolution of this capital migration is already targeting a sector far more vital than real estate.